All right, so let's start and let's go straight to the second slide, P. P. Please go to P. This is what it's all about for 2021 and 2022. It's P. It's not P like a pandemics, but it's a P like prices, policies, and politics. We really think what's happening on the price front, on the inflation front, it's important. Should we be concerned? Yes, we should be concerned. Not in Europe, but in the US. Should we be worried? No, not yet. But inflation developments, and having seen the CPI print in 5% just for the last month in the US, tells you that there is a lot of pent-up demand, obviously, but also there's much more price pressure than one has expected. Some of it is mechanical, it's base effect, yes, for sure. We estimate that Swiss Re is about 50% of the inflation drive is base effect, but not the rest. So closely monitor price development is important. Policy is super important as well on the policy front. Obviously, we are thinking here about central bank policies and what Madame Lagarde is doing in Frankfurt. We care. Also what Jerome Powell is doing, and this is even more important. And all they are doing is they are keeping a dovish central bank policy intact, no question about that. But what if there are changes on the front, and what could bring the changes? We're also going to talk more about that. But definitely what's happening on the policy front is going to shape the restart of our economies. And third, what's happening by policies, it's driven by politics. It's not just US and China, it's also the politics within a country. And we do believe the social increase in terms of tensions, the fractions that we have been seeing that has existed already pro-COVID, hasn't gone away, but it has accentuated further. And politics, they're reacting to it. Politics are reacting to the increase in fractions, to increase income inequality, not just across countries, but also within countries. And what politicians are doing, it's impacting policies. And what policies are doing, it's impacting us. And that's why I'm really happy that you have us as a guest to talk about global economic and insurance outlook, to really pinpoint of and share with you in our thinking, and hopefully also get to a discussion at the event in terms of how you see the key piece impacting your world and your economies. Well, this is just introductory remarks, and obviously any global economic outlook without point forecast wouldn't be economic outlook. So that's why let's go to slide 3, please. On slide 3, you see our forecasts versus consensus and the key points. And the key message that we want to share and leave with you is that, yes, this is a strong recovery, no doubt about that. But much of it is happening because we have put the tape recorder on pause, and now we have put it on play, and it's obviously rebounding a lot, strongly. Also, obviously, thanks to the fiscal monetary policy, as well as the central bank policies interacting with each other together with the vaccine rollout, which is finally progressing also in Europe. And this is even giving for Europe super strong growth environment. We forecast for the Eurozone 4.2% this year. This is more or less actually consensus figure. For next year, a little bit more positive than consensus, a little bit more positive than consensus, because we see there has been a lot of broken macro environment in the meantime, and not just in the meantime of COVID-19, but also before. And more stimulative fiscal and monetary policies is helping, especially the growth environment in Europe. But what you see also on this slide is Eurozone growing much stronger. And second, you see also inflation. It's nothing to worry about in Europe. We expect CPI in the order of around 1.7% and 1.2% next year. So again, more deflationary environment actually still in Europe, which is different than what you see and what we see in the US. In the US, we see much more increase for consumer price inflation. That's definitely something which is different. And what does that mean for the insurance sector? This means for the insurance sector, with lower inflation in Europe, interest rate environment will likely also remain lower in Europe relative to the US. And you see it here in our forecast. Yes, we still expect German bonds and also Austrian rates to remain in negative territory this year, to slowly go into, but really slowly go into more positive territory. And even in the US, please have a look at our forecast, 10-year rates, 2%, even though it's booming in the US because of this unusual cocktail of opening up vaccine and the biggest stimulus in our lifetimes, even that will not lead to interest rates exploding. Quite the contrary. Demographics and structural factors will keep interest rates low for longer. I think this is important. I think this is really important because it means there's going to be more focus on the underwriting. There's going to be, second, more focus also in the business model. And third, I think it's also going to be more focus in how we provide risk coverage, in how we use data, and how we bring the products to the clients. Just one statement there. And yesterday, on Friday, I had a presentation to Canadian clients. And who would have thought on Friday, on the same day I was presenting to Canadian clients, that actually Budweiser, yes, Budweiser, the beer company in Canada, actually I didn't know, but it's the most used beer in Canada. Budweiser on Friday, they went online and saying that they're going to enter the insurance world. So here we go. Maybe the line between traditional insurance players and non-traditional insurance players also becomes more blurry in Europe. I don't know. You definitely have more insights here for Austria, but let me tell you, it's happening. At least in Northern America, the line is really, really blurry. In terms of what to watch, and I would like to highlight 3 key themes. Let me go first, please, to slide 5. You can skip the next slide. Let's go straight to slide 5. 3 key themes I would like you to get out of this presentation. And it matters as an insurance player. Yes, our core business is underwriting, but we're also a long-term investor. So don't forget the law of gravity. Don't forget what it means if Lagarde is staying in negative territory for policy rates. It means for asset allocation, and asset allocation is allocating assets. It means, don't forget Tina. Tina, that means there is no other alternative than being invested. Meaning, yes, risky assets, yes, financial markets will remain supported up to a certain point. Up to the certain point, I will talk more about it later on. But low rates, low interest rate, and especially super negative interest rates we are experiencing in Europe, it's a positive factor for financial markets and also good for asset management in insurance companies. And that helps to take some pressure away from underwriting, but definitely with interest rates environment remaining low for longer, the pressure on underwriting will stay, pressure on the business model will stay. Just think about Budweiser. Second theme, and please go to the next slide. Second theme I would like to highlight is what happens with central banking, super important. That's why I highlighted policies as one of the key pieces in the beginning. The central bank put, it's here and it's alive. What is determining the central bank put? It's being determined by a few factors. It's being determined by inflation, GDP, financial market fragility, as well as politics. And politics, in our view, is driven by social peace, as well as the polarization of politics. And social peace, it's income inequality and inclusive growth. Now I know this is big picture thinking, but I think it's important to think about what is driving central bank put. As long as we don't have inflation pressure, the central bank put in option terms, it will remain in money. Now it's being recalibrated to be a little bit outside of the money. But as long as we don't have runaway inflation, and we won't, central bank put is alive. But it's not just inflation that matters. It's also politics. It's also social peace, income inequality. And fact is, COVID-19 has accentuated income inequality quite a lot. And that's why in the US, I'm more concerned about central bank put being rewritten than in Europe. If in the US you have longer inflation for longer time period, then this is not good for lower income households, because inflation is being felt much more, consumer price inflation is being felt much more by lower income household, while the asset price inflation, which is the other side of low interest rates, right, with Tina, it's not being widely shared either. So there will be a time also where the central bank in the US will say, what's more important, inflation inclusive growth or financial stability? And they will have to come and say, well, actually, it's inclusive growth. And that's why also they will not allow inflation to be much higher than 2%. Third point I would like to highlight is in the next slide, please. Besides Tina, besides central bank puts, let's remember, please, yes, we're going to see diverging recoveries across regions, with China going stronger than the US and US stronger than the Eurozone, but also within the Eurozone. And in my view, Austria, the Northern European countries, they will continue to grow stronger than the Southern European countries, because they will be able to take more the benefit of this paradigm shifts with digitalization having accentuated. And digitalization accentuating is going to mean more competition. What you also see in this graph, however, besides divergence in GDP and economic recoveries, you see that economic healing, especially for Europe, it's difficult. Please have a look at the gray line. You see the gray line, it's not coming back to 100 for the forecast horizon of 2021. It's not even going to come back to the economic trend growth in 2022. So it's going to take some time, considerable time for economic healing. And that's why we say cyclical recovery, it's here. But please don't mistake it with a structural recovery, especially not in Europe, because it isn't. This is on the economic environment, and no economic environment, I think, nowadays should be given with really highlighting what's also super important for the longer term picture. And for us at Swiss Re, and sustainability and resilience, I think, for the insurance sector at large is super important. It's what we can bring as a sector in terms of added value, obviously, to the clients, sustainability and improving sustainability. That's why I'm super optimistic, actually, for the insurance industry, the primary insurance industry, especially. COVID-19 is a systemic risk, and with a systemic risk, government had to step in. But now governments, hopefully they step out, and hopefully the insurance sector steps in again and provide coverage. Let's have a quick look at climate change. Go to slide 9, please. Slide 9. Slide 9, here you see our Economics of Climate Change Sigma report, which we published about 1 month ago, and received well-deserved attention, I would say, because this is the first attempt ever at looking at the economic impact of climate change to physical risk and acute climate change risk, and what's more, it takes a scenario perspective. Fact is, the Paris Agreement, we are really far away. It's now a best case scenario that we are going to be below the 2-degree temperature increase by 2050, but it's not the baseline. That's why it's green here in this table. Fact is, the baseline is, that's what scientific literature tells us, the baseline is that temperature increase is going to be somewhere between 2 to 2.6 degree in terms of average temperature increase by mid-century by 2050. But the severe scenario, but not implausible, is a 3.2 degree temperature increase. Two figures I would like to highlight. One, the top right-hand corner figure, minus 18.1%. The global economy is at risk of being almost 20% smaller by 2050. If you have such a severe but not implausible scenario, then otherwise would be the case. And that's huge. That's huge. Even if you reach Paris Agreement, we're going to feel an impact of around 4%. We don't want to be alarmist here, no way. But it's important to put a price tag on these costs to help all of us to position against inaction, because at the end of the day, it's going to be inaction, which is going to be the most costly strategy. And the other side of these costs are opportunities for insurance coverage. Just think about natural catastrophes as one big example. Fact is, 3/4 of NatCat events is still not insured. There's still protection. The protection gap is still huge, and protection gap will only increase. And with insurance industry having such a big knowledge in terms of climate change modeling, we can add a lot to the policy debate, but then also a lot to products, into bringing the right products to the markets. But worse definitely is inaction. And definitely the benefit is acting, no question about that. If I go to the next slide, please, slide 10. On slide 10, if I think about Austria and a new market, I definitely would see for Europe a really special place in terms of making it work on climate, and also obviously for Austria in terms of being a hub for green investing and insurance products, which help the transition phase for the region, for the CEE region, but then also for Europe. And I think with Europe still having a lot of miles to go to make a true European capital market union, you are well positioned in having strong relationship with the CEE region to position yourself for these future opportunities in the green finance area, in the insurance area, for helping the transition to be made for climate change. Let me show you one more slide, and then we'll close and hand over to Irina for the much more exciting development which is happening on the insurance premium front. And I would like just to highlight the last slide, which is slide 12, please. Next slide. I talked about resilience, and actually the insurance industry at large, it's all about resilience. And what we have been doing since 2 years, 2 to 3 years, is providing on an annual basis. And anyone on the call or seeing this webinar, happy to share the details. It's out there. It's part now of the Dow Jones Index family. We are providing macro resilience indices, and as an alternative way to look at cyclical data, to look at the GDP data. And we do believe the macro resilience factors and scores and ranking, which is between 0 and 1, it's much more important than just the actual GDP figures, because it tells you much more about a country's ability to withstand shock and then also rebound. And at the same time, we also share insurance market resilience indices across the core perils, and also this for more than 30 countries. And you see here on this slide, and you see actually also with Austria being red here, you really see that it pays out to have a macro resilience. Macro resilience can come from a lot of factors. It also comes from having enough buffers on the fiscal and monetary front, and it comes also in having a well-diversified economy, and that includes insurance markets. So with this, please don't forget the letter P, don't forget Tina, don't forget also that it's super important to think about the central bank put and the divergence in real economic growth. Thanks for your attention so far. And with this, I'm happy to hand over to Irina. Irina, the floor is yours. Thank you.
Thank you, Jerome. Before I get into the insurance outlook, I would like to follow up with Jerome has just mentioned about the resilience. Actually, this is Jerome have highlight about the macro resilience, right? But actually, we have four family of indices. We have also three on the insurance side. One is to measure the net how the economy will absorb the natural catastrophe shock. The other one is on mortality risk, and the other one is on health. So for Austria, for this year, actually, we just released the ranking for, 30, about 30 countries about their, resilience in terms of how to absorb the natural catastrophe shocks. So you may be interested to know that actually Austria ranked 11th among all the countries. It's about in the middle, and it's about 41% of the natural the losses caused by natural disasters are being covered by insurance. So that means about 60% of which still have to be covered from either government's pocket or from the household's pocket. But if you look at this number, you already found, 40% doesn't mean very high, but I have to tell you, in some part of emerging Asia, emerging markets, the number is less than 5%. That means 95% of the natural catastrophe related losses actually have to pay by government or households. So this will be something that, we could, if you're interested, we can further discuss about it. Okay, so I think it's also in line with Jerome have just mentioned about the economic of climate risk. These are the areas really have to think deeper. So may I have slide 14? Thank you. So this is the insurance premium outlook. So Jerome have so kind to really, tell about a very strong recovery of the economy, right? So what about on the insurance side? So here again, I would like to highlight some big picture. If we look at the left-hand side one, okay, we have 2V, right? So what was that? So the gray one is actually what happens, in the past, the last time the global financial crisis. How does the P&C premium, really the market, responds? You look at that. At that time, T0 meaning at the time of the crisis. That means if today is 2020 and the last time is 2008 or 2009, right? At that time, you can see that the global P&C premium actually dropped by about 2.something%. But bear in mind, at that time, the global recession, globally, the economy only dropped by less than 2%. But today, the global economy dropped by close to 4%. Okay, so a much deeper recession. But look at the red line. Okay, today you can see that although there's a deep V, look like it, but look at the absolute level. For the P&C side, we still manage to have a positive growth, or more or less, not falling into the contractionary point. So you can see that actually the insurance market are much more resilient to the COVID shock this time, much more resilient to the global recession this time. Look at the left-hand side. This is the life and health, life and health side. So again, you can see that, different lines represent, different historical picture. But let us look at the light blue one. This is also the last time the global financial crisis. You can also see that, there's a deep V, and then really the life and health premium actually contracted by over 5, it's about 7%. But this time, look at it, the dip is much shallower. And then the rebound, look at the red line, is much sharper. So why would that really be the case? I think unlike the previous, economic crisis, people really thought about, without the money, so they will for the life side maybe they will lapse, and then for the premium side, because the economy is doing no good and the business doing no good, people just try to stop buying insurance. But this time, one very important thing about the COVID is that one of the positive things is about it bring a very increased in awareness of the risk. People really think about in terms of the risk protection. So that's why you can see that on the P&C side, one of the very important reasons to make it still positive growth during the crisis and a strong rebound for close to 4%, for 2021, it is because of the commercial lines rate hardening. So why would the commercial lines be hardened? Of course, I think the poor losses experience counts, the COVID-related losses count. However, also corporates also see more increasing need for the risk protection. That's why you can see that in the next slide, I will tell you more about that. But this is also go into why we have a very strong rate hardening, in the commercial lines, especially in terms of, say, the cat related, and that property side, we have the business interruption related. You can see that very strong rate hardening on that. And then the other things about is like, on the life and health side, right? We also see that we didn't do much from the European front, but we did do a lot of consumer survey in Asia Pacific. And we find that consumer actually, they buy more insurance during the COVID time. They reach out to their insurers proactively. This is a very, very interesting phenomenon, because we often said that, insurance is often being sold than, being, demand for. But this time during the COVID, we find that consumer actually proactively reach out to the insurers. So that's also show that, the rising risk awareness is really very important to support. That's why we have a much resilient growth in the market. And here, for this slide, I would like to share with you that, because I understand it from the Austrian market, P&C side is more, the bigger share of the market, much stronger than the life side. And on the other hand, for the P&C side, also the motor is also a very important share of the market. But this time you look at it, if on the left-hand side, we are telling that for the industry's profitability, for 2020, you can see the very dark blue. This is actually the contribution of the profitability from the motor, mainly due to, the lockdown. There's no mobility, right? So there's no claims, right? But for this year and next, how would it happen? We will see that actually the contribution from motor will decline sharply for 2021, so that you can see why we see the underwriting profit, although it's still good, but decline sharply. It's because of the motor profitability, because the gain from the lockdown will phasing out in 2021. But the positive sign is that if you look at the commercial property, we still see continued rate hardening in the I would say loss affected lines. So you can see that for instance the blue one. So we can see that a significant rate hardening will still go into the commercial property. And in Europe, Austria, they go very much, I think the market dynamic go very much in line with the continental advanced market. So we can still that for complex risks, there will still continue to be rate hardening. But for, I think the less affected lines, then the rate will decline. I will say still positive increase, but will slow down much more. Okay, so this will be the two major, I would say, key highlights from the insurance side to share with you. But even though it is not really in the slide, I would like to share one thing about inflation that Jerome talks about, right? Although that's I would say less an issue in the medium term. And Jerome also mentioned about that probably that will be less an issue for the European market, but maybe you may still ask, if inflation really stayed there, what are the lines being affected? So two things to like to share with you about the inflation. First of all, we will find that actually the residential property, they will be much more sensitive to the consumer price inflation. For most of other lines, they are more sensitive to the wage and healthcare inflation. So for this part, we also do some empirical study and finds that during high inflation period, this will be more, you will see that the inflation, whether it's wage, healthcare, they will be more likely transfer into claims inflation. So it will make put into higher claims. and then also the CPI as well. But during the low inflation period, so in case of Europe, then we will find that the translation or the transmission mechanism will be much, much weaker. So that's why, again, we don't see very phenomenon for the claims inflation in Europe as well. So I will stop here and then over to you, Jerome, to give an overall conclusion and key takeaways. Thank you.
Hey, thank you very much, Irina. Well, to sum up, on the macro front, yes, this is a big bounce back. It's a super strong cyclical recovery, but please don't make it mistake it with a structural recovery. We are not there yet. Good news is, however, 2021 and 2022 reasons to be optimistic. But again, we are still prone in terms of accidents and also how we're going to deal with the next recessions, and especially in Europe, we don't have well enough defined buffers, especially on the fiscal front, but also on the common European capital market front to deal with the next recession. Second, if you think about what it means for insurance markets, good news is, as outlined by Irina, there is more reason to be optimistic for insurance markets. First of all, we had seen the bounce back for insurance market premiums much earlier, and we were outspoken already last year during the very deep global recession. We were saying already that insurance markets going to bounce back, and they have bounced back big time. So more reasons there to be optimistic. And third, yes, we truly believe because of COVID-19 that digitalization, the way how we're going to price risk through data, through technology, but also the way how we're going to distribute insurance products. We have a lot to gain as an industry and as a sector, and also in terms of how we can improve resilience, that we let the acceleration in digitalization, be it distribution or be it pricing front with more innovative solutions, that we embrace this. I think it's a huge upside positive for our industry. And of this positive note, let me stop and give it back to the moderator. Thank you.
Yeah, thank you very much, Jerome Haegeli and Irina Erfahren. Thank you for sharing your insights and your global economic and insurance outlook with us. I would like to hand over to Peter Leusel. He is the moderator of the Versicherungsforum in Austria for a short Q&A, and afterwards we switch into German and he will give us a short overview of the highlights of the program of this year. Peter, your turn, please.
Well, thank you very much, Jerome and Irina. I would like to comment one statement of yours, Jerome. There was a warning that Budweiser enters insurance. So I think we are totally aware of the threat of the big tech GAFA, Google, Apple, Facebook, Amazon. But why should we fear Budweiser? I mean, is it more than capital? I mean, it's okay if they expand their activities, but I wouldn't see any skills special threats. With GAFA, we are totally aware that they have skills and access to customer data. But what was the reason why you mentioned Budweiser as an impressive new fact for the insurance industry? Please comment that.
Thanks a lot, Peter, and thanks a lot for asking. And I think I emphasize it for the same reason that you are surprised that I mention it, because I'm surprised that the beer company is entering the insurance industry. No surprise, right? That Google has tried to enter insurance industry. Actually, they exited again, and there will be other trials with big tech, as you mentioned, for sure. The big tech having controlling the data and controlling the ecosystem, that's in some sense, if you want to call it a threat, the big threat for sure. But seeing that traditional companies enter the insurance industry, I think should also be a wake-up call for all of us, right? That lines between traditional, non-traditional companies that could enter the insurance sector maybe is getting much more blurry than what we thought. And maybe it's you see it also in other product areas. It's not so important whether you're big tech or not. It's important whether you have a product to sell. And if you have a product to sell from the real economy, then you can bundle everything, which is so annoying. And often it is insurance markets, the policies and the fine details of the policies, right? That you bundle it together. So I think that's for me the big threat. Big threat is the intermediation of traditional insurance player. And I think digitalization brings a risk to it, that it makes it easier for non-big tech companies to enter the space. And that's why I think we as traditional players, we have to be even more sharper. We have to be even more upfront in terms of embracing the technology, using it to our positive advantage. And if I say advantage, I don't mean pricing advantage. I mean advantage in bringing the right products out to the market, which makes sense for society, because only we have that knowledge. And that I think is a super competitive power that we will continue to have for still some time. So yes, Peter, sorry for the long answer. I emphasize it because I was also surprised seeing such a player entering the insurance market. I thought it's interesting to share with you. Thank you.
Yeah. Okay. Maybe I would like to comment on that for one time more. You just mentioned that Google goes in, gets out again, because Google has a real ambivalent situation. They earn such much money with their insurance selection, and so entering insurance maybe kills the enormous amount of money they make by comparing insurance sites. I fear more Amazon because they know so much about the customer behavior. But if you're now, if I understood you correctly, if you are now stating that Budweiser maybe has a chance of bundling products, what would that be? A beer insurance? I mean, I'm just kidding, but what could be the threat that Budweiser has? What could be the skills, the abilities of Budweiser in making insurance products?
Well, I'm not representative of the company, right? So it's not to me to answer what makes it appealing. But I think what makes it appealing is just the process of bundling a product insurance market policy, which is not usually the most exciting product, right? Where you would get together with friends to celebrate. Yes, you wouldn't get together with friends and celebrate, yes, I did a new insurance policy, but you would get with friends together and maybe enjoy a beer over the European Championship. Okay. I don't know, right? But I think that lines are getting much more blurry. And I take your point on Amazon versus Google. And I think our advantage in our traditional industry is, A, we have the reputation in terms of pricing risk and knowing our client for a really long time. B, insurance industry is very well regulated. And then I think that's also the reason why it's a reputation risk for some of the big techs to go in. And third, it's super capital intensive. And as you all know, and we know, big tech, it's more capital light. Yes, high market value, but capital light and intensive on the intangible asset side.
Okay, thank you very much.
Thank you, Peter.
So are there any questions or comments from the community to Jerome or Irina?
So far not. So once again, Mr. Jerome and Haegeli and Irina Fan, thank you very much for sharing your time with us and your insights. And regards to,
May I add one comment? Because I think
sure.
I think we did a lot of research, and then there will be a lot of interesting. Can we go to the last slide, or so that maybe the audience can thought about, if they like to know more on slides 20, that actually they could visit our website, and we produce about 100 reports in a year. So there will be a lot of interesting topics. There should be definitely one for you.
I think it's slide 18, right?
Oh, sorry, slide 18. Okay, sorry. Yeah.
18.
And if you have a QR reader, and you probably have,
yeah.
you go to the restaurant also in Austria, here you can easily get access to it. Big thank you again from us, from Irina and myself, to have invited you to your important forum. Thank you very much, Pete. Thank you very much, Gerhard. Thank you to all of you and Raphael as well. Looking forward, maybe next time in person, that would be much more fun, right?
That would be great. Thank you very much. Bye-bye.
Have a great day. Bye. Bye.
So, lieber Peter, du wirst uns nun die Highlights noch vom diesjährigen Insurance Forum Austria präsentieren, das seit vielen Jahren in Rust am Neusiedlersee seine Heimat hatte und nun erstmals im Balance-Ressort am 4. und 5. Oktober stattfinden wird. Worauf können wir uns in diesem Jahr besonders freuen? Bitte.
Ja, vielen Dank, Gerhard. Ja, es ist ja die Top-Konferenz in Österreich. Es gibt keine vergleichbare Plattform. Und sie versteht sich ja als Zukunfts- und Querdenkerforum. Also wir wollen schon ein bisschen in die Zukunft schauen. Und das betrifft zwei Themen insbesondere. Es ist die Begegnung der vielen etablierten Player. Also die CEOs der Großen sind fast alle da, mit spannenden neuen Insurtechs und New Players. Also es ist also Platzhirschen treffen auf junge Wilde, könnte man sagen. Und was mir besonders wichtig ist, weil ich ja schon, Gerhard, seit, glaube ich, wie lange gibt es das Insurance Forum eigentlich schon? Wie viel das Jahr ist das jetzt?
Das 9. Mal ist es 2021.
Ja, okay. Also ich kenne es von Anfang an, und was es sicher in den letzten 2, 3 Jahren entwickelt hat, es ist internationaler geworden. Und das betrifft insbesondere Deutschland. Ich meine, Jerome war jetzt ein gutes Beispiel, aber die Schweizer sind ja etwas zurückhaltender. Aber man kann wirklich, nicht nur beim Fußball jetzt bei der Euro, aber man kann im Versicherungsgeschäft schon sagen, dass wir natürlich sinnvollerweise auch aufgrund der Ähnlichkeit der Märkte gut beraten sind, nach Deutschland zu schauen, weil sich dort die Entwicklungen um einige Jahre früher abspielen. Es ist nämlich schon so, dass wenn man sich den englischen, amerikanischen oder auch skandinavischen Markt anschaut, dort ist das Kundenverhalten so viel anders, dass das zwar beeindruckend ist. Ich meine, jeder weiß oder viele wissen, dass in England und Skandinavien teilweise der Direct-Kanal, also ohne Berater, teilweise 50, 60, 70% Marktanteil hat. Das ist beeindruckend, aber das können wir gleich wieder vergessen, weil das einfach komplett andere Marktverhältnisse sind. Insofern ist Deutschland meiner Meinung nach der Markt, wo man wirklich genau hinschauen sollte, weil dort die Dinge, die dort passieren, die werden mit großer Wahrscheinlichkeit ein paar Jahre später auch in Österreich aufschlagen. Und so ist es in den letzten Jahren gelungen, recht intensiv und auch wirklich relevante und gute Leute auch aus Deutschland zur IFA zu bringen. Also wir haben etablierte Player und junge Wilde und Österreich und einen ordentlichen Input aus Deutschland.
Vielen Dank, lieber Peter, in deiner Rolle hier als fachlicher Leiter der IFA, des Vorsitzenden des Fachberates. Auch an dieser Stelle vielen Dank an unseren wichtigen und engagierten Fachberat für das Engagement schon im Vorfeld. Und natürlich freuen wir uns wieder, wenn du als Moderator die IFA 2 Tage lang begleiten wirst. Ich danke auch an unsere Partner, die sich diesmal bei der IFA präsentieren werden. Und abschließend zu deiner Frage: Die Teilnahme bei der IFA wird ausschließlich unter der sogenannten 3G-Regel stattfinden. Das heißt genesen, geimpft oder getestet. Insofern mit den Möglichkeiten, hier auch das Hotel mit den unterschiedlichen freien Rahmen zu nutzen, glauben wir aus heutiger Sicht oder sind sehr zuversichtlich, eine sichere Durchführung zu gewährleisten. Was die anderen Auflagen betrifft, orientieren wir uns dann selbstverständlich zu den zu diesem Zeitpunkt geltenden Vorgaben und Vorschriften, die wir in unser umfangreiches Sicherheits- und Präventionskonzept einfließen lassen werden. Ja, in diesem Sinne freuen wir uns auf eine persönliche Begegnung mit Ihnen. Unter businesscircle.at finden Sie das aktuelle Programm. Vielen Dank nochmals an alle Beteiligten und ja, auf ein Wiedersehen am 4. und 5. Oktober bei der IFA 2021 im Balance-Ressort Stegersbach. Vielen Dank.